Morning everybody, and thank you for being here for our monthly update on the Edge Invest Human Credit Fund. The month of August was a negative month for us. We're down around 40 basis points, predominantly due to our position in oil Brazil. There was a lot of noise and rumors around the company. Most of them they're proven unfounded and ungrounded, and we think the company will recover very well. We think it's a strategic asset in Brazil, and we do expect plenty of M&A activity either with domestic players or with international players, among others being AT&T being rumored in the last couple of weeks. So we think it's just a temporary blip on the story, and which we kind of like, and it's very much within our strong focus on the telecom sector across Europe and America. Away from that, the rest of the fund performed relatively well. Macro was quite positive. I think our trading of both Treasury and BTP tactically was quite positive. We think Italy actually is going through a relatively positive trajectory now, with cost of funding being reduced and being quite positive overall for the government, the newly installed government, which we think will meet quite a few of the favors from the European Commission that the previous governments couldn't rely on. Away from there, our main focus remain on the macro side, Brexit. Our most likely sequence of events is a sequence of events which until a few months ago would have been probably viewed as zero probability, most of them. We do see a constitutional crisis in the middle of October, followed by a potential vote of no confidence on Boris Johnson, which will probably be likely to still trigger kind of no-deal Brexit at the end of the October, with the deadline 31st of October, and that will be then followed by election. The key thing for us to monitor, to adjust our positioning, is going to be the polls, polling indication from the electorate in UK, that would effectively determine the direction of both Conservative and Labour Party, but obviously with a strong focus also on Lib Dem and the Farage Party, which will have an instrumental and pivot role in the upcoming election and possibly in the new government. So on Brexit, we remain positioned for a much more dovish Bank of England, which should come anytime before the no-deal Brexit, or even on the eve of that. So we think rates are very high in UK, they will come down. We think the UK banks are very vulnerable, both to the domestic and also to the international picture, given their exposure to Hong Kong, namely Standard & Chartered and HSBC. We remain quite negative overall, and we think the assets are quite mispriced given what we think are the probability of the different events. Away from that, on events, it was another very strong month for our positioning on Osram and Celgene Bristol Myers. We think there is plenty of opportunity for a bit of a bidding war on Osram. We think AMS is ready to increase their bid, potentially including an equity stub, which would please some of his core shareholders such as Allianz. We think Carla will top up again, probably in the next couple of weeks before the end of September, and that would then trigger another response from AMS. Interestingly enough, we think also there's a technicality of domination agreement in Germany, which probably creates the opportunity for a double-digit return here over the next few weeks. So we kind of like Osram. At the same time, we think Osram AMS will fit perfectly with our view of dangerous M&A transactions. We've seen plenty of that in the past: Walgreens, Rite Aid, AT&T, Time Warner, and we'll see plenty again. We have a situation of an acquirer which is kind of desperate to make the acquisition of Osram. We have a company which is in dire need of restructuring, which is Osram, and we think there's going to be potentially more cost to be borne in the future, especially from the credit side on both AMS and Osram, but for the time being we're going to enjoy the bidding war. Away from that, on the overall macro view, remain of the same opinion. Obviously there's a lot of expectation for central banks. Central banks may freak out and deliver on the nervous expectation of the markets. We think there is a chance, given the positive notes on trade war, the bullishness about Brexit not being an extreme event. We think central banks may actually be quite relaxed and under-deliver at the upcoming meetings. We have the ECB this week, tomorrow actually, and then the Fed next week. Overall, our main focus remain the collateral damage, the collateral cost of QE, and is mainly two things. One is a massive gap between asset inflation and salary deflation, and that would create more populist pressure, more requests for fiscal expansion, more political tension across countries like trade war, protection, and so on. The second issue, which is much more long-term and probably more predictable, is going to be what we call the tech winter, because rates are zero. Any business plan looks amazing, especially with the 20 or 30 years, we will see plenty of startups, plenty of companies like investing in new technology, and those will be highly disruptive, and particularly disruptive for highly levered sectors. We're very focused within that theme around the telecoms. Like I said before, with Oi Brazil, we think mobile will probably be one of the sectors very much exposed, like US with Verizon. We think there's going to be plenty of sectors that will suffer in the next few quarters because of the slow motion that we see coming from new competitors, either existing one reinforcing themselves with technology, or newly created startups. With this, I thank you very much, and I wish you all the best. Thank you.